For the past 20 years, tech stocks have followed the golden rule of turning over billions in profit, buying back their stock, and making investors rich. However, Google's parent company Alphabet has just torn up that playbook. For the first time since their IPO, instead of buying back their stocks, they are printing 80 billion of brand new equity and dumping it into the market. So let's start from the basics. What does it actually mean if a company prints new shares? When a company is already publicly traded, it has a set number of shares outstanding. If you own a share, you own a fixed piece of that company's future profits. When a company decides it needs a massive amount of cash, it has two choices. Either borrow the money from a bank, which creates debt, or it can create brand new shares out of thin air and sell them to investors. This is called equity financing. Think of it like a pizza. If a pizza is cut into 8 slices and you own 1 slice, you own 12.5% of the pizza, which is the company. If the company suddenly decides to cut the exact same pizza into 12 slices to sell the extra 4 slices to new people, your single slice didn't change in size, but it now only represents 8.3% of the whole. In finance, this is called dilution. You still hold the same stock, but your ownership of the company's total earnings has just shrunk. Mechanically, dilution actually changes something within the company, and that is called EPS, which is earnings per share. Obviously, with the release of loads of more shares, their earnings and their gross profit is split between more shares. So their earnings per share actually decreases. This is only because if their earnings stay the same and the number of their shares increase, then obviously the earnings per share will go down in value. So one of the reasons why Wall Street has dumped the stock, and it went down 4% when they announced this news. It also has a second meaning because executives treat their stock as if it's a currency. And when do you want to sell or use a currency is when it's priced highly. So them making this decision when Alphabet was at near all-time highs kind of tells you, without them telling you themselves, that they believe the company might be overvalued or is very highly priced. So why did Alphabet decide to do this and not just use the pile of cash they have from Google? For 20 years, Silicon Valley became dominant, and that is because software was cheap to scale. You build a code once and then you can sell it to billions of people. However, AI totally flipped the switch. Now it requires millions of specialized NVIDIA GPUs, massive industrial scale data centers, and gigawatts of electricity to cool them down. Alphabet is projected as 2026 capital expenditure to be $180 to $190 billion. And in 2027, they're expecting it to be even higher. But why didn't they just borrow the money? That is because interest rates are at multi-year highs. And instead of borrowing the money, that would destroy their quarterly income statements. So instead, they issued 80 billion of new shareholder equity. When they did this, they sold 10 billion to Berkshire Hathaway just to show market confidence, and the rest of the shares they will drip feed over time. This way, they are only sacrificing a bit of shareholder ownership. For long-term investors, this is not a reason to panic sell Google, but it is a massive reality check as it proves the AI boom isn't just a high-margin software fairy tale. It shows that it is capital hungry, and if a cash flow king like Alphabet and Google are already asking for help with a foot in the bill, it does show that some of these AI companies who are not turning over as much profit and sitting on just as much cash might have issues to come.